Close your eyes now and rest. May these hours.
Terus bangun ya. Tugas banyak banget lagi ya. Sorry. Ini main video ya?
I'm sorry because that was just a little bit of entertainment. So good morning everyone, wherever you are and whenever you are. I'm Markov Kelvin, and in this video, I'm going to be talking about the lessons learned in this corporate finance subject lectured by Prof. Roy at IPMI International Business School. So let's just get started. And in this subject of corporate finance, these are the materials that have already been covered. We have Intro to Financial Management, Time Value of Money, Capital Budgeting, Analysis of Securities, and so on. Next are the points and subpoints of the Intro to Financial Management material. The first one is about the goal of financial management. The second one is about principal-agent problem. The third one is about important financial concepts. The fourth one is about the goal of the firm. The fifth one is about the four cornerstones of corporate finance. And the sixth one is about 5 business essentials by an Indian-American business consultant, Ram Charan. For goal of financial management, we have 4 different types of goals. First is about the basic objectives. For the basic objectives, financial management will maximize 2 different things, which are wealth and profit. Wealth maximization and profit maximization. Both wealth maximization and profit maximization will create significant and sustainable value creation. The second one is about the operational objectives that aims for the time availability, the most effective utilization of finances, the safety of investments, and the growth of enterprises. The third is about social objectives for timely payment of interests, taxes, and wages, payment of reasonable dividends, fair settlement with suppliers, and maintaining relations with financiers. The fourth is the research objective, which aims to research new and better sources of finances. Next, we have principal-agent problems, and we are going to be concerning about the problems and solutions. And the principal-agent problem is about a conflict in priorities between a person or group and the representative authorized to act on their behalf. And first, we are going to talk about 3 main problems, which are the conflict of interest, asymmetric information, and moral hazard. Then, what will be the solutions for those 3 main problems of the principal-agent problem? Based on what we have discussed, there shouldn't be a 100% correct solution for principal-agent problem. However, there are principles that are close enough to cover the problems, which are the GCG principles, or good corporate governance, or tarif, or TRAIF. The first letter T is about transparency. The second letter A is about accountability. The third letter R is about responsibility. The fourth letter is about independence. And last but not least, letter, which is F, is about fairness. Additionally, we have many important finance concepts that are already mentioned in this class. We have risk-return trade-off, time value of money, cash is king, and so on. Other than financial management goals that I have already mentioned, now we do have the goal of the firm itself. We have 3 things to be maximized and 1 thing to sustain. The 3 things that have to be maximized are profit, shareholders' wealth, and stock price. And 1 significant thing that has to be sustainable is profit. There are also 4 cornerstones of corporate finance. The first is about core of value principle, which is about value. And value is driven by returns. The second one is about the conservation of value principle, which is you cannot create value by rearranging claims on cash flows. The third one is about the expectations treadmill principle, which explains about the more investors expect your share price, the better you must perform to keep up. The fourth one is about the best owner principle, which explains about business value depends upon its owner's capabilities. Then, 5 business essentials by an Indian-American consultant, Ramcharan, are also mentioned. The first is cash. The second is profit margin. The third is velocity. The fourth is growth. The fifth one is customer focus. The time value of money, or TVM, is also one of the materials that are mentioned in this video. The concept of TVM is about the value of money yesterday, today, and tomorrow are different. If we receive $1 today, it is worth more than $1 in the future due to opportunity cost. We also have the rule of 72 and the applications of TVM. Here is the rule of 72. Rule of 72 is an approximation of compound rate. For instance, how long does it take to double $5,000 at a compound rate of 12% per year? The answer is approximately 6 years because we use the rule of 72, which is 72 divided by the interest, or I%, as the compound rate 12%. So the answer is 6 years, which is still very close to the actual time. And there are several applications of the time value of money. It can be used for mortgage and car loan payments, life insurance, personal financial planning, time deposits, and so on. After that, we have capital budgeting. It is about a process for investment in long-term assets. Also, it is a decision-making criterion whether we should accept or reject a long-term investment proposal. And to know all the criteria, we need to understand several things, which are NPV, PI, and IRR. Next is about analysis of securities or portfolio investment. And there are 2 types of investing, active and passive. In passive investing, investors are just following the market. However, in active investing, there are fundamental, technical, and market investor sentiment analysis. Fundamental analysis is about domestic and global economic analysis, industry, and company. For technical analysis, there are many things. It's about uptrend or downtrend, support and resistance, triangles, moving average, and etc. In market sentiment analysis, it's about investor attention or which are the best stocks to trade. In capital structure material, there's a theory by Modigliani and Miller in 1958 that explains tax deductibility of interest payments. The optimal capital structure is 100% debt. Also, a benefit of debt financing is that interest is tax deductible, whereas payments to equity providers are not. Firms also must trade off this benefit against the increased financial risk associated with higher debt levels. Next, we have corporate restructuring, which covers the outcome of financial distress, surviving and transforming business, and restructuring corporate culture. About the outcome of financial distress, it has a turnaround opportunity and also a permanent problem. For the turnaround opportunity, we have 3 things to restructure. First is about operations restructuring. Second is about asset restructuring. Third is about financial restructuring, which is about the private workout or filing for legal bankruptcy. The second is about the permanent problem, which is about private liquidation and also filing for legal bankruptcy. Another corporate restructuring variable is about surviving and transforming business. To survive and transform the business, we have to stop the bleeding, do financial restructuring, temporary pivoting, strategic realigning, redefine the core business, and find new ways of doing business so that we can survive and transform. And these are the things to restructure the corporate culture. The first is about the capital structure. The second is about working capital management. The third is asset structure. Fourth is revenue management. Fifth is cost management. Sixth is cash flow management. The seventh is growth management. And last but not least is about risk management. Then we have material about fraud risk management. This material talks about shenanigans, fraud triangle, and also occupational fraud. The shenanigans has 3 different definitions. The first is about devious tricks used especially for an underhand purpose. The second is a high-spirited or mischievous activity. The third is about a secret dishonest activity or tomfoolery, silly, and high-spirited mischief. As I have mentioned before, which is about shenanigans, there are actually 7 shenanigans. The first one is recording revenue too soon. The second one is recording bogus revenue. The third one is boosting income with one-time gains. The fourth one is shifting current expenses to a later or earlier period. The fifth one is failing to disclose all liabilities. The sixth one is shifting current income to a later period. And last but not least, which is the seventh one, is about shifting future expenses into the current period. there's also a subtopic about occupational fraud and abuse with its reasons. There are three types of occupational fraud and abuse: corruption, asset misappropriations, and fraudulent statements. Corruption is based on conflict of interest, illegal gratuities, and economic extortion. The second one is about asset misappropriations, is about cash and inventory and all other assets. The third one is about fraudulent statements, which relate to financial and non-financial. There are also several reasons for occupational fraud and abuse. The first one is huge personal debt or losses. Second is about lifestyle beyond income capacity. And after that, we have over speculation in get rich quick scheme, because people just want to get rich quickly, and gambling, and etc. And this one is about the fraud triangle. The three fraud triangles are perceived opportunity, which is about weak internal controls. Perceived pressure is about greed, addictions, dissatisfactions with pay, and etc. And rationalization, like people might say, I'll pay back, or I deserve a pay raise. In issues in finance material, we concern on the book review summary from the first group to the last group that is already organized in this subject. The first group discussed about the psychology of money by Morgan Housel. The second group discussed about the intelligent investor by Benjamin Graham. The third group was about the low risk to value method to high returns by Monish Pabrai. The fourth group discussed about the little book that beats the market by Joel Greenblatt. And last but not least, Group 5 discussed about the Warren Buffett Way by Robert G. Hagstrom. We also did learn about dividend policy. But first of all, let us start with what is the dividend. A dividend is the distribution of a company's earnings to its shareholders, and it is determined by the company's board of directors. And here's about dividend policy. When we pay dividends, stockholders receive an immediate cash reward for investing. And in dividend policy, it also involves two decisions. The first one is about how much of the firm's earnings should be distributed to shareholders as a dividend. And after that, it is also about how much should be retained for capital investment. For the last meeting, we have discussed some materials in brief. The first is about international finance, but it previously mentioned about greed is good. And after that, followed by exchange rate. For greed is good quotation, it is by Michael Douglas, or Gordon Gekko in Wall Street movie. He said that greed, for a lack of better word, is good. Greed is right. Greed works. Greed clarifies, cuts through, and captures the essence of the evolutionary spirit. Greed in all of its forms. Thus, greed is good for certain conditions. We also have discussed exchange rate, which is about inflation differential, income differential, government trade restriction, and also interest rate differential and capital flow restriction as the risk perception. After that, we have some different kinds of event analysis from different groups. The first group discussed about the Medco acquisition of ConocoPhillips. The second group discussed about the Breeze merger. The third group discussed about Blibli.com. The fourth group was about GoTo merger. And last but not least, Group 5 was about Indosat Oredo Hutchison. Last but not least, which is about portfolio performance evaluation. After we already discussed about all of our stock picks from Group 1 to 5, then it's explained about market efficiency. In market efficiency, prices reflect all available information from weak to strong efficiency. The general strategy in market efficiency is diversify and passive investing. And the lesson learned from our lecturer is that is the market efficient? So the answer, it is not about a yes or no. It's not about black or white. It is a spectrum. And yeah, that's the end of this video. You wanted more? No, just kidding. Anyways, thank you for watching this video, and if you like this video, please don't forget to like, comment, and subscribe so that I can pass this subject. Just kidding.